Hello, my name is Magnus Petersen. This talk is about how to protect your investment against inflation. It is based on this book, and you can click on the image or the link below the video. Inflation is the increase in prices of goods and services over time. For example, in 1950, a 12-ounce bottle of Coca-Cola cost 5 cents. In 2015, a 12-ounce can of Coca-Cola cost 40 cents, depending on where you bought it. This is an 8-fold increase in price over 65 years. This corresponds to an average price increase of 3.3% per year. Such price increases are typical for most goods and services, and inflation should be expected to continue in the future. The Consumer Price Index measures the price change for a basket, that is, a list of goods and services consumed by typical US households. Housing is about 42% of the total expenses for a typical US household. Food and beverage are another 15%, and transportation is also 15%. Between 1950 and 2015, the CPI increased 3.6% per year on average. This means the price of goods and services consumed by typical US households increased tenfold between 1950 and 2015. Some years had very high inflation, for example in the 1970s, while a few years had deflation, which is falling prices, and this happened in the financial crisis in 2008 and 9. The CPI measures the change in prices of goods and services, while the purchasing power measures the corresponding change in the amount of goods and services that $1 purchases. The purchasing power is defined as 100 divided by the CPI, which starts at 100. So if the CPI increases to 200, it means that the purchasing power has halved. Another example is if you had $1 in 1950 and you spent it on Coca-Cola at 5 cents per 12-ounce bottle, then you would have bought 20 bottles in 1950. If instead you had kept the $1 in a safe and spent it in 2015, then you would only get 2.5 cans of Coke for $1. So the purchasing power decreased in those years. Between 1950 and 2015, the purchasing power of $1 halved every 20 years on average for common goods and services. The plot on the left shows the inflation measured by the CPI, and the plot on the right shows the purchasing power, which is 100 divided by the CPI. So the CPI starts at 100 in 1950 and goes to about 1,000 in year 2015. And the purchasing power of $1 in 1950 decreases to maybe 10 or 12 cents in 2015. Note, for example, in the 1970s where the inflation is very high, so this curve gets steep in the 1970s, and this means the purchasing power decreased a lot in the 1970s. So you should not keep cash for extended periods of time because inflation will destroy their purchasing power. You can instead invest in US government bonds. Between 1962 and 2015, the interest earned on US government bonds with 1-year maturity was greater than inflation in 7 out of 10 years. On average, the bond yield was 1.5 percentage points greater than the inflation rate. The worst year was 1974, where bonds yielded 7.3%, but inflation was 12.2%. So your purchasing power still decreased almost 5%. The best year started in September 1981, where the government bonds returned more than 17% and inflation was only 5%. Treasury inflation-protected securities, also known as TIPS, are US government bonds that are also protected from price inflation. But the yields on TIPS are also lower than for normal bonds. The difference is a market's expectation for future inflation. Whether TIPS or normal bonds are better depends on whether the actual inflation is lower or higher than the expected inflation. This is impossible to predict. TIPS also have long maturity of 5, 10 or 30 years. So you must be able to own TIPS until they mature, because you could lose a lot of money if you sell before maturity. This is also known as interest rate risk. You can also invest in the so-called S&P 500, which is a stock market index of 500 large US companies. Between 1962 and 2013, the S&P 500 returned 7.1% more than inflation per year on average. But the S&P 500 is very volatile in any single year. The S&P 500 outperformed inflation in 7 out of 10 years. Over longer periods, the S&P 500 performs increasingly better. The S&P 500 outperformed inflation in 75% of all 10-year periods, and the S&P 500 outperformed inflation in all 20-year periods between 1962 and 2013. So the conclusion is that inflation destroys the value of cash savings. Historically, US government bonds protected against inflation in 7 out of 10 years. It is impossible to predict whether TIPS will be better or worse than normal bonds. The S&P 500 offers good long-term protection against inflation, but it crashes sometimes. The book gives more details, and you can click on the image or the link below the video.